All of us know, and painfully so, that prices of tomatoes have surged at a scorching pace in recent times. July inflation numbers were expected to be high, but they still threw a nasty surprise. They exceeded expectations. But are food prices the only contributors to overall price rise? Let's find out. Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. July's print for inflation came at a shockingly high 7.44%. This compares with a much lower 4.87% seen in June. Why this makes us feel that inflation is truly high is that this 7.44%, which is incidentally a 15-month high, comes on an already high base of 6.7% seen a year earlier, that is, in June 2022. The chart on your screens shows you how inflation has behaved over almost 3 years, that is, beginning November 2021. The figure on the extreme right of your chart is the July print, that is 7.44%, and that's the highest in this period except for the about 7.8% seen in early 2022. Tomatoes are not solely to blame for all of this price rise. In an editorial, our sister publication Business Line points out that tomatoes, onions, and potatoes are highly volatile when it comes to price changes. And because of the significant volatility, they have an outsized effect on the overall price rise. Why outsized? Because they actually contribute to a small portion. They account for about 2.2% of the consumer price index. There are other components of the index that have contributed to the overall price rise, but before that, here is an important assertion that the RBI has made. In its monetary policy statement on August 10th, the Reserve Bank of India said that given the likely short-term nature of price shocks from vegetables, monetary policy can look through high inflation prints caused by such shocks for some time. However, not all of these price shocks may be seen as temporary, because as Business Line points out, pulses in cereals have been contributing to overall inflation for some time now. Price rise on cereals has been significant at 13% for July, and cereals account for about 12.4% of the overall index. Likewise, acreage under some pulses has decreased. Milk prices shot up in July by 8.34%, likely due to fodder availability issues. All these give rise to a niggling suspicion that some structural supply side issues may be building up and that these are not so temporary as may be believed. And to be sure, in its latest monthly bulletin, the RBI acknowledges that there indeed have been some supply side shocks and that we may not have seen the end of it all. In the July bulletin, authors of the article on the state of the economy say the shadow of El Niño looms over the second half of the year and the outcome for food inflation in the Rabi season. They also point out that yet another upside risk is the outlook on crude oil prices that is marred by engineered supply shortfalls. And engineered here means production cuts that have been decided upon by key OPEC plus suppliers. The authors also feel that there is a diminishing probability that crude prices would ease as we go through the rest of the year, and this, they say, bodes ill for a net energy importer like India. Bodes ill for India likely hit the nail on the head. In a recent analytical piece, my colleague in Business Line, Rishi Ranjan Kala, points out to the tight rope walk that the government must now do, because international crude oil prices have risen to recently, on average, about $85 per barrel. And the discounts we used to get from Russian crude is also not significantly high as compared to earlier. Logically, oil marketing companies must be allowed to raise prices of fuels at the pumps, places where you and I buy petrol and diesel. But allowing that to happen literally adds fuel to fire, because inflation is already high, and if petrol prices and diesel prices are allowed to go higher, that would only spur inflation even further. RBI's own estimates for inflation were that it would float higher in the middle part of this fiscal year. That forecast is coming true, but likely at an even higher rate than what even the central bank anticipated. During the August monetary policy meeting, it revised upwards its estimation for inflation. The chart on your screens shows how the RBI's own estimate for inflation has changed between June and August. So in the latest estimate, the RBI has said that inflation is expected to be about 5.4% for all of FY24. This compares with 5.1% estimated in June. And likewise, both the quarters ending September as well as December are estimated to show higher inflation than expected earlier. Why is high inflation even more of a concern now for the economy than earlier? A couple of other disconcerting trends make this so. One is that corporate India seems to be able to show significantly higher growth in profits than for revenues. This is according to an analysis that Business Line did of 1,505 firms. It says that bank credit demand has remained high, perhaps hinting at more credit-funded consumption. Consumer services, ranging from realty to hospitality, seem to be slowing down. To be sure, the data also shows higher government spending on infrastructure as part of its capital expenditure plans. This is generally expected to have a multiplier effect on private sector capex. But the private sector also waits for consumption trends to remain consistent before investment flows can follow suit. The other disconcerting trend is that our trade with the rest of the world has slipped a bit in recent months. This is to be expected because of the gloomy economic environment in the rest of the world. For India, both exports and imports slipped in July, imports more so than exports. Though lower imports could give a breather to the Indian rupee, which has seen a sharp deterioration in recent days, it also signals weak domestic demand, which has a telling effect on economic growth. In sum, we seem to be getting mixed signals. On the one hand, we have data such as inflation rate and trade data that are alarming. On the other, we have some healthy and stable goods and services tax collections and a record number of returns that have been filed for income tax and so on. So maybe the coming months would give us a better idea of India's economic trajectory. And if anything comes up in between of consequence, we will certainly keep you posted. Did you know that when inflation starts to bite, shadow inflation generally abounds? What is shadow inflation? It is an interesting concept. Remember when a few weeks ago, branded outlets in India selling burgers or sandwiches stopped using tomatoes because tomatoes were too costly, but you were still getting those edibles at the same prices. When your neighborhood restaurant gives you less of your favorite dish than earlier, but for the same price, that is one form of inflation called shadow inflation. If you're waiting longer in queues or waiting longer for a table to be served in a restaurant, or when you stay at a hotel, the frequency in which a room is cleaned is lower than earlier. These are all forms of inflation, but not measured in the true sense. That brings us to this week's quiz question. What is the link between hyperinflation and the fall of the Roman Empire? This is interesting. And before you think we've forgotten the answer to last week's, here goes. Last week's question was, who said this? Copying other countries' solutions to problems you do not have or focusing on trendy issues that are not really important is a recipe for inefficiency, if not disaster. The answer is Ricardo Hossman in an article he wrote this June on industrial policy for Project Syndicate. The question was not so much about the importance of who said it as to what he actually said. That's all we have for now, but we'd certainly like to know about your experiences with high inflation. How has it touched you? Tell us in the comment section below. Love to hear from you. And before you go away, do not forget to like, share, subscribe, and importantly, click on the bell icon. Till we meet again, have a lovely week ahead.